You aren't taxed on how much money you make, you are taxed on how much money you keep. The bridge between those two numbers isn't about loopholes or tricks, it's about valid small business tax deductions. It's time to stop fearing the tax code and start using it to build your wealth. Let's get into it. We talk to a lot of new business owners, freelancers, consultants, tradespeople, and when tax season rolls around, I see two distinct emotions: fear and greed. You're terrified of triggering an audit, so you don't claim enough, or you're desperate to lower your bill, so you try to claim everything, including your dog's organic treats. In the eyes of the law, your tax liability is based on profit, not revenue. The bridge between that big revenue number and that smaller taxable profit number, those are your small business tax deductions. I want you to change your mindset right now. Stop looking at deductions as loopholes, tricks, or working the system. If you take the safe, simple, sound approach, deductions are simply the mathematically accurate way to calculate the true cost of doing business. It's not magic, it's just math. When you claim a valid deduction, you aren't getting away with something. You are accurately reporting that, hey, it cost me money to make this money. So, how do you know what counts? Before you ask me, Alex, can I write off my morning latte, you need to learn the golden rule. It's the filter every single expense must pass through. It's called the IRS Ordinary and Necessary test. Let's break that down, because these two words might not mean what you think they mean in regular conversation. First, the expense must be ordinary. This doesn't mean boring. In tax terms, ordinary means it is common and accepted in your specific trade or profession. Context is everything here. Think about it. If you are a house painter, buying high-end paintbrushes and drop cloths is an ordinary expense. It makes total sense. But if you are a virtual financial consultant and you try to write off $500 worth of paintbrushes, that's going to look weird. That is not ordinary for your industry. Ask yourself, looking at my industry, what is an expense that is ordinary for me but might look totally strange to an outsider? If you're a dog walker, poop bags are a legitimate write-off. If you're a graphic designer, not so much. Second, the expense must be necessary. Now, this is where people get tripped up. You might think necessary means indispensable, like you literally cannot survive or function without it. That is not the IRS definition. To be a valid self-employed tax write-off, necessary just means the expense is helpful and appropriate for your business. For example, do you need the absolute fastest top-tier internet speed to run your Etsy shop? Maybe you could survive on the slow tier. But is the fast tier helpful and appropriate for efficiency? Absolutely. Therefore, it meets the necessary test. This is vital for handling your sole proprietorship taxes. You don't have to starve your business of resources just because they aren't life or death. If it helps you grow and it's common in your field, it's likely deductible. So how does viewing deductions as math, rather than loopholes, change how you spend? It removes the emotion. It allows you to look at a purchase and say, is this helpful? Is this normal for my job? If the answer is yes, you keep the receipt and you lower your tax bill. Simple as that. Key takeaways. 1. Shift your mindset. You are taxed on profit, not revenue. Deductions are the bridge. 2. Deductions are accuracy, not tricks. They represent the true cost of doing business. 3. The golden rule. Every expense must be ordinary, common in your field, and necessary, helpful, and appropriate. Here is your call to action for this segment, and I want you to actually do this. Open your bank app right now. Review your last 3 business purchases and explicitly apply the ordinary and necessary 2-part test to each one. Say it out loud. Is this ordinary for my job? Is it helpful for my business? If it passes, you're safe. All right, so we've established our golden rule. We know that to be deductible, an expense has to be both ordinary and necessary. We've moved past the fear of can I buy this and into the confidence of this is a legitimate tool for my trade. But now, we have to take all those receipts and actually put them somewhere. We're moving from the philosophy of spending to the geography of the tax form. Welcome to the big buckets. If you were to look at a blank tax return, specifically the Schedule C expenses section, it can look like a wall of text. But I want you to visualize it differently. I want you to see it as a series of buckets. Your job, as the steward of your business finance, is to make sure you're tossing every valid receipt into the right bucket so nothing gets left on the floor. Let's walk through the biggest, most common buckets you're going to encounter. First up, we have cost of goods sold, or COGS. Now, if you're a graphic designer or a consultant, this bucket might be empty for you, and that's fine. But if you make something or you buy something to resell it, this is your lifeline. This isn't just the wood for the table you built or the wholesale price of the t-shirts you're selling. It's also the freight in, the shipping costs to get those materials to your door. It includes storage. It includes direct labor. Think of it like this. If you bake cookies for a living, your flour, chocolate chips, and the cost to ship that fancy vanilla extract from Madagascar, that's all COGS. If you aren't tracking this, you aren't seeing your true profit margin. Next, let's talk about a bucket that trips up almost every new entrepreneur: salaries and wages. Here is the hard truth for my sole proprietorship taxes people out there. You generally cannot deduct the salary you pay yourself. I know. You transfer money from your business checking to your personal checking every Friday and call it payroll. But the IRS calls that an owner's draw. As a sole proprietor, you aren't an employee of your own business. You are the business. You don't get a W-2 from yourself. You simply pay tax on the profit that's left over. However, if you hire an assistant, a junior designer, or a salesperson, the wages, bonuses, and commissions you pay them, absolutely deductible. That goes right into the salaries and wages bucket. Moving on to our third bucket, fixed and operational costs. These are the things that keep the lights on. This includes rent. And I don't just mean office space. If you had to rent a high-end camera lens for a shoot or a bulldozer for a landscaping job, that's rent on business property. It's fully deductible. This bucket also holds your insurance. We're talking liability insurance, workers' comp, or theft insurance. And it includes interest, but only on business debt. If you have a business credit card or a loan specifically for equipment, that interest is a write-off. And finally, let's look at the taxes and licenses bucket. This one confuses people. You cannot deduct your federal income tax as a business expense. That would be a weird circular loop. But you can deduct state and local taxes directly related to the business, as well as business license fees. If your city charges you $100 a year just to operate, that's a deduction. So I want you to pause for a second and reflect. As a sole proprietor, have you been inadvertently trying to deduct your own draw as a salary expense? If so, don't panic, but do flag that for correction and ask yourself, which of these big buckets represents your largest cost center? Are you capturing every valid expense within it? If COGS is your biggest expense, are you remembering to include the freight costs? Here's your mission for today. I want you to open a blank Schedule C form. You can find a PDF online easily. Or open up your accounting software. Look at your expenses from just the last month. Take 15 minutes and categorize them into these specific buckets we just discussed. Don't worry about being perfect. Just get used to seeing your money in these categories. Once you've got your buckets sorted, you might notice a glaring omission. We haven't talked about your car yet. That's because vehicles are tricky. They are the danger zone of small business tax deductions. So keep that Schedule C open, because coming up next, we're going to navigate the mixed-use trap and figure out if you should be tracking mileage or actual expenses. You won't want to miss this. We are moving from the black and white areas into the gray areas. I call this the danger zone. This is where your business life and your personal life tend to crash into each other. And it is exactly where the IRS likes to look the closest. We're talking about mixing personal and business expenses, and specifically the tricky world of vehicles. Here is the reality for most of us, especially if you're a solopreneur or freelancer. You don't stop being a person just because you started a business. You use your cell phone to call your mom and your biggest client. You drive your car to the job site and to the grocery store. This brings us to the most critical concept for your Schedule C expenses, the mixed-use rule. The IRS is strict here. You generally cannot deduct personal living or family expenses, period. If you buy a laptop and use it 100% for work, that's easy. But what happens when you use an asset for both? You have to put on your math hat. You must calculate the business percentage. Let me give you a real-world example to make this stick. Let's say you run a flower shop. You have a van. Last year, you drove that van 20,000 miles in total. You tracked it, and you know that 16,000 of those miles were delivering bouquets to weddings, and 4,000 miles were you driving to the movies or picking up groceries. Here is the math. 16,000 business miles divided by 20,000 total miles is 0.8 or 80%. That means you can only deduct 80% of the cost of operating that van. If you try to deduct the full 100%, you are waving a red flag at the IRS. You are effectively asking the government to subsidize your personal life, and they do not like that. Now, speaking of that van, let's zoom in on vehicles specifically, because this is one of the biggest small business tax deductions available, but it confuses people the most. When it comes to your car, you have two distinct paths you can take. Path number one is the actual expenses method. This is exactly what it sounds like. You track every single penny you spend on that car, gas, oil changes, new tires, insurance, repairs, and you multiply that total by your business percentage, that 80% we just talked about. Path number two is usually simpler, the standard mileage rate. The IRS sets a specific rate. It changes slightly every year, but it's usually around 60-something cents per mile. You just take your business miles, multiply it by that rate, and boom, that's your deduction. No need to tally up every gas station receipt. So the big question I hear all the time is standard mileage rate versus actual expenses. Which one is better? The honest answer, it depends on your car and how you drive. If you drive a fuel-efficient hybrid for thousands of miles, the standard mileage rate often wins because you get a huge deduction for low operating costs. But if you drive a heavy-duty truck that guzzles gas and requires expensive repairs, the actual expenses method might save you way more money. But, and please hear me on this, there is one constraint that applies to both methods. You have to track the miles, whether you are claiming actual expenses or the mileage rate. If you are audited, the IRS will ask for a log. They want to see the date, the miles, and the business purpose. If you use your vehicle for mixed use, and you aren't tracking exactly when you are on the clock versus off the clock, you are putting your self-employed tax write-offs at risk. You cannot guess at the end of the year. I want you to take a second and reflect on your last week. Are there areas in your spending where your personal and business lives are blurring? Are you swiping the business card for a coffee that wasn't really a client meeting? Are you driving to a job site but forgetting to log the odometer reading? These little slips are what get us into trouble. So here's your takeaway. Don't fear the mixed-use assets. Just manage them. Separate the funds where you can, and when you can't, do the math to find the accurate business percentage. And here is your challenge for this week, your call to action. I want you to look at your driving for the last year. Calculate your vehicle deduction using both the actual expenses and standard mileage methods. Run the numbers. You might find that switching methods puts an extra $1,000 in your pocket, or you might find that the simplicity of the mileage rate is worth its weight in gold. But you won't know until you do the math. Now, once you've done that calculation, you're going to have a number. But a number on a page isn't enough to satisfy the tax man. You need proof. So up next, we're going to talk about audit proofing your business and why a credit card statement isn't as safe as you think it is. Let's say you did drive those miles for a client. Let's say you did buy those supplies. How do you prove it? This brings us to our final and arguably most critical topic for the day, audit proofing. And I know record keeping sounds like the most boring phrase in the English language. It sounds like homework. But today I want to change how you see it. We aren't going to look at it as admin work. We are going to look at it as stewardship. Now, in our safe, simple, sound philosophy, being safe doesn't just mean you aren't breaking the law. It means you are audit-proof. Here is the scary reality that catches so many new entrepreneurs off guard. Proof of payment is not the same thing as proof of a deduction. I'll say that again because it's vital. The IRS explicitly states that proof of payment by itself does not establish that you are entitled to a tax deduction. Here is a real-world example. Let's say you're looking at your credit card statement and you see a line item, Target $150. To you, you know that was for printer paper, pens, and a whiteboard for your home office. But to an auditor looking at that statement 3 years from now, that $150 at Target could be anything. It could be office supplies, sure, but it could also be groceries, a new swimsuit, or a video game. The credit card statement proves you spent the money, but it doesn't prove what you bought. This is why relying solely on bank statements is dangerous. To be truly safe, to be audit-proof, you need the itemized receipt. So what makes a receipt valid? You need to look for the 4 pillars. Whenever you shove a receipt into your pocket or snap a photo of it, check for these 4 things. 1. The amount. How much was it? 2. The description. What is the actual item or service? 3. The date. When did it happen? 4. The vendor name. Who did you pay? If you have those 4 data points, you have a bulletproof defense for your small business tax deductions. I want you to take a second and reflect. If you were audited today, right this second, could you produce an itemized receipt for your 5 largest expenses of the year? Or would you just be frantically downloading credit card statements, hoping the IRS takes your word for it? This brings me to the mindset shift. I want you to stop looking at keeping receipts as a hassle. Reframe it. This is business record keeping as stewardship. Think about it this way. Every valid receipt you save is cash you are legally keeping in your business. It's money you don't have to send to the government. If you lose a receipt for a $100 business expense and you're in a 25% tax bracket, you effectively just threw $25 in the trash. When you view organization as stewardship, you aren't just doing paperwork. You are protecting the profit you worked so hard to create. You're ensuring that when you claim those Schedule C expenses, they stick. So here is how we are going to apply this immediately. I have a challenge for you this week. I want you to log into your bank account and pull up your credit card statement for the last month. Highlight every single business expense on that list. Then I want you to locate the actual itemized receipt for each one. If it's digital, put it in a specific folder. If it's physical, find it. If you catch a missing receipt now while the trail is fresh, you can often recover it. But if you wait until April, it's gone. Remember, you aren't taxed on what you make, you're taxed on what you keep. And good records help you keep more. That wraps up our deep dive into expenses and deductions today. Stick to the ordinary and necessary rule, keep those personal and business funds separate, and safeguard your receipts like they are cash, because they are. Thanks for listening to the Safe, Simple, Sound podcast. Go be a good steward of your business, and we'll see you next time.